People love to believe that market bubbles happen because people become irrational, but the truth is far more unsettling. Market bubbles happen because people behave exactly the way the human brain has evolved to behave. And if you think you're immune, history suggests otherwise. Imagine standing in a crowded room where everyone is getting richer. Your neighbors are making money, your coworkers won't stop talking about their latest investments, and social media is filled with stories of overnight success. At some point, staying on the sidelines starts to feel riskier than joining in. That's the psychology behind every market bubble. A market bubble begins with a genuine opportunity. Maybe it's a groundbreaking technology, a booming housing market, or a revolutionary digital asset. Early investors profit, and those profits attract attention. Soon, excitement replaces careful analysis. Prices rise not because assets are becoming more valuable, but because people expect someone else to pay even more tomorrow. Economists call this the greater fool theory, but psychologically, it's driven by hope, greed, and the fear of missing out. History has repeated this pattern countless times. In the 17th century, the Dutch Tulip Mania saw rare flower bulbs selling for astonishing sums. Centuries later, the dot-com bubble convinced investors that nearly any internet company would become the next big success. Then came the housing bubble, where many believed property prices could only move in one direction, up. More recently, cryptocurrencies experienced dramatic surges fueled by excitement, speculation, and stories of life-changing gains. Different assets, same human psychology. What's fascinating is that intelligence doesn't protect people from bubbles. In fact, highly educated investors can become even more confident in flawed decisions. That's because our brains are wired with cognitive biases. Confirmation bias pushes us to seek information that supports our beliefs while ignoring warning signs. Herd mentality makes following the crowd feel safe, even when the crowd is wrong. Overconfidence convinces us we'll exit just before everyone else does. And recency bias tricks us into believing that recent gains will continue forever. Neuroscience adds another layer to the story. Every profitable investment can trigger the brain's reward system, releasing dopamine, the same chemical involved in motivation and anticipation. The more prices rise, the more rewarding investing feels. Eventually, many people stop investing based on facts and start chasing the emotional high of making money. That's why bubbles often grow long after rational analysis says they should end. The hardest lesson in investing is that markets don't reward excitement, they reward discipline. When everyone is euphoric, asking difficult questions becomes more valuable than celebrating easy profits. Successful investors understand that patience often feels uncomfortable because it goes against our natural instincts. So the next time everyone insists that this time is different, pause for a moment. History rarely repeats itself exactly, but human nature repeats itself with remarkable consistency, and understanding your own mind may be the most profitable investment you'll ever make. If you enjoyed this episode and want more insights into the psychology of wealth, investing, and smarter financial decisions, don't forget to like this video, subscribe to the channel, and share it with someone who believes markets only go up. Until next time, stay curious, stay disciplined, and remember, the greatest investment isn't just in the market, it's in understanding yourself.